On May 5th, the company that has come to define this entire crypto cycle reported the single largest quarterly loss in its history. Strategy, $12.54 billion gone in a single quarter, but that's just the headline. Sharplink, the second largest ETH Treasury company on the planet, dropped another $685 million. Trump Media bled out $405 million more. So we are talking about over $13 billion in combined losses from the exact companies that were supposed to be the structural flaw of this bull market. And here's what makes this truly extraordinary. Nobody in the system did anything wrong. The playbook worked exactly as designed. It's just running in reverse. So today we'll break down what Q1 actually revealed, dismantle the dilution mechanic that turns these companies into forced sellers, and give you the complete overview. Who survives, who gets wiped out if Bitcoin takes another leg down. I'm DC and you're watching the Coin Bureau. Now, before we get into the carnage, you need to understand what these companies actually represent to the market. Public companies collectively hold roughly 1.2 million BTC. That's about 5.5% of the entire circulating supply locked into corporate balance sheets. Strategy alone holds close to 844,000 BTC, which is about 4% of every Bitcoin that will ever exist. On the Ethereum side, Bitmain Immersion holds 5.28 million ETH, which is 4.37% of the total Ethereum supply, and Sharplink holds another 873,000 ETH. In Q1 2026 alone, Strategy added 89,599 BTC, spending roughly $7.3 billion in a single quarter. In January, Strategy accounted for 97.5% of all new Bitcoin purchased by public companies. To put it simply, the Treasury company bid was not some wild institutional demand wave, it was one company with one very large bet providing the marginal buyer that everyone else was front-running. And that bid is now under heavy stress for the first time since this model was invented. Which brings us directly to the numbers that Saylor is probably not too thrilled about. Strategy's $12.54 billion Q1 loss is almost entirely non-cash, driven by the new fair value accounting rule that forces them to mark Bitcoin to market every quarter. BTC fell roughly 22% from year-end 2025 to the March 31st reporting date, and that drop landed straight on the income statement. The cash position sits at $2.2 billion. Long-term convertible debt sits at $8.17 billion. And the MNAV ratio, the premium the market assigns to MSTR over the Bitcoin it actually holds, has compressed from a peak of 3.89 times in late 2024 to approximately 1.0 times today. For context, when MNAV was 3.89, investors were paying nearly $4 for every $1 of Bitcoin on the balance sheet. So today, MSTR's market cap is in line with or slightly below the fair value of its Bitcoin holdings. So in other words, the premium that powered this entire flywheel has largely evaporated. And that premium is the engine. When it compresses, the ATM equity issuance machine that funds new BTC purchases starts running on fumes. So on May 15th, Strategy announced plans to repurchase $1.5 billion of its 2029 convertible notes, with funding sources cited as cash, ATM proceeds, and the potential sale of Bitcoin. Yep, this could actually be happening. Let the reality of that sink in. The company, built on a never sell policy, just officially opened the door to selling. Of course, the stock dropped 5% on this announcement, and Jane Street, one of the most sophisticated trading desks on this planet, cut its MSTR position by 78% in Q1. The smart money is already repositioning. Now look, Strategy is the disciplined version of this playbook. The copycats, however, this is where things get really ugly. Sharplink ended Q1 with $16.9 million in cash against an ETH position worth roughly $1.85 billion. That's a cash cushion of less than 1% of their treasury, and their annual fixed charges run $22.3 million. So the math here is absolutely brutal. They are entirely dependent on staking revenue covering operating costs, and ETH is down 29% year to date. Then there's Trump Media. DJT generated $871,200 in quarterly revenue. Not million, thousand. $871,000 in revenue, supporting a $2.3 billion market cap and a 9,542 BTC treasury. And according to SEC filings, a significant portion of their Bitcoin holdings are pledged as collateral against convertible debt, exposing the position to margin call risk if Bitcoin keeps dropping, which is not good. The CEO resigned mid-crisis and insider selling is documented in SEC filings from March and May. Now, on the flip side, the company is in advanced merger talks with a nuclear fusion firm called TAE Technologies, which means shareholders who bought DJT as a Bitcoin proxy may end up owning an energy company instead. Nakamoto Holdings posted a $238 million Q1 loss, has 87% of its BTC pledged as collateral, and the CEO's compensation reportedly jumped sevenfold while the company sold 284 BTC just to fund working capital. And of course, we should absolutely trust that a company selling its core asset to pay operating expenses while paying its CEO 7 times more is following the disciplined Saylor playbook, right? To make matters worse, public miners sold 32,000 BTC in Q1 alone, more than all of 2025 combined. Put simply, the structural supply picture is deteriorating at exactly the moment the structural demand picture is cracking. Which brings us to the mechanism that actually kills these companies, the dilution death spiral. And it works like this. While the stock trades at a premium to NAV, the company issues equity at that premium, buys Bitcoin at spot, and the premium expands as BTC appreciates. That's the exact flywheel everyone fell in love with from 2020 to 2024. But when BTC falls, NAV drops and the premium compresses towards 1. And once that happens, issuing equity is no longer accretive, there's no premium left to capture. And if it drops below 1, it becomes actively dilutive. The company is now selling shares worth less than the Bitcoin those shares represent, so they pivot to preferred stock, which carries fixed dividend obligations that do not care what Bitcoin does. Strategy's Stretch Preferred carries an 11.5% dividend. Total preferred dividend obligations are projected to rise from $217 million in 2025 to roughly $904 million in 2026. That's a 4-fold increase in fixed cash obligations in 12 months. If the ATM stalls, they have to fund those dividends from cash reserves, meaning the $2.2 billion cash position covers roughly 18 months of obligations. After that, they have to sell Bitcoin. And then, in the worst case, the reverse flywheel starts. Bitcoin selling pushes prices lower, NAV drops further, the premium compresses more, and the loop accelerates downward. Of course, you might assume this is hypothetical, which today it still is, but we saw something very similar happen 5 years ago. In 2021, the Grayscale Bitcoin Trust traded at a premium to NAV of up to 46%. Three Arrows Capital, Genesis, BlockFi, and Celsius all used GBTC shares as collateral for loans, recycling that collateral into more BTC purchases. And when the premium turned into a discount in early 2022, the flywheel reversed. The GBTC discount eventually reached approximately 41% below NAV by November 2022. Three Arrow Capital's collateral became worthless relative to the loans backing it, forced liquidations cascaded through Genesis and the entire centralized lending sector. By the time it was done, roughly $2 trillion in crypto market cap had vaporized. The institutional plumbing of the 2021 cycle was structurally broken. Today, GBTC trades at a 2.81% discount to NAV. So the premium era is completely over. And the structural parallel to MSTR is essentially identical. Swap GBTC for MSTR shares, swap Three Arrow Capitals for any institution using MSTR as portfolio collateral, and you have the same reflexive trap, just at a much larger scale. GBTC peaked at roughly 40 to 45 billion in assets at the height of the 2021 bull market. Strategy's Bitcoin holdings alone sit near $64 billion. The honest truth is that the Treasury company trade was always just a leveraged bet on Bitcoin going up forever. It was simply dressed up in financial engineering language and sold to retail as institutional adoption. The smart money knew exactly what it was. That's why Jim Kanos closed his MSTR short and PTC long pair trade in November 2025, after the MNAV compressed from 2.5 times to 1.23 times. He called the use of debt and preferred stock to buy Bitcoin financial gibberish. And he was right on the trade. You see, most coverage misses a crucial detail. These companies were only ever marginal buyers of convenience, viable only while the premium held. Now the premium has collapsed, the never sell promise is broken, and the next leg down doesn't just hurt MSTR shareholders. It removes the single largest source of structural demand crypto has had all cycle. So for you, for me, for us, for everyone holding crypto, the practical implications are very specific. First, we have to watch the MNAV ratio on Strategy Weekly. The 1.22 threshold is the inflection point Saylor's own team has identified as critical. Below 1, the ATM is dead and the forced selling becomes the base case. Second, watch the collateralized positions across DJT and Nakamoto's 87% pledge ratio. Those are essentially margin call timers, and a drop toward the 52-week low at $62,791 lights them up. Third, watch the preferred dividend calendar. The $904 million 2026 obligations is the structural cliff, and any missed payments shifts board voting rights to preferred shareholders. Fourth, track ETF flows daily on far-side investors as the cleanest read on whether spot demand can replace any disappearing Treasury bid. Spot ETFs hold roughly 1.3 million BTC and continue absorbing flows, but those flows are reversible and volatile in ways that corporate accumulation was not. Now, fifth, for your own portfolio, treat self-custody as the structural protection. Wrapper risk is real. Custodian concentration sits near 80% with Coinbase across these products, and the cleanest exposure to Bitcoin will always be Bitcoin you actually hold. So here's the question all of us need to answer honestly. Does the Treasury company unwind turn out to be a healthy flush that removes the most fragile leveraged players from the market and resets the cycle on cleaner structural footing? Or does the forced selling cascade from the zombie tier of these companies trigger the kind of reflexive liquidation that took crypto from $2 trillion to $800 billion in 2022, with deeper institutional contagion this time around? Please get highly opinionated in the comments, because this is the binary that defines the next year. And if you want to understand exactly how we got here, FASB's new fair value accounting rule created this mark-to-market trap, and it's now down to the SEC to decide whether the damage accelerates or gets contained. Then you should definitely check out our full breakdown of the regulatory architecture right over here. Thank you all so much for watching, and I'll see you again very soon. This is TC signing off.